The leading economic indicators index has just fallen once again, now for the 22nd month in a row, extending its streak with a decline of 0.4% on a month-over-month basis for the month of January. Now, this decline was alarmingly higher than the expected decline of 0.1%, with average weekly hours worked being the main driving factor behind this decline. However, most other metrics were also negative. This 22-month streak of declines is now equal to the one that was seen between June 2007 and April 2008, which of course coincides with the global financial crisis and paints a very grim picture of what could be coming next. Now, the LEI is one of the most accurate and reliable indicators that is used to predict where the economy is heading in the future and when a recession is coming up. And it does use a broad range of different economic metrics to get an unbiased forecast. Now, this chart showing the indicator on a year-over-year percentage change basis does demonstrate just how accurately the indicator has been in predicting recessions, correlating almost perfectly with all of the historic periods of recession. The Congressional Budget Office has also come out with an updated budget and economic outlook for the next 10 years, and their predictions are pretty damning. Now, they project that the federal budget deficit will remain high at $1.6 trillion in fiscal year 2024 before growing to $1.8 trillion in 2025 and then rising all the way to $2.6 trillion by 2034. Now, debt held by the public is projected to grow to 99% of GDP at the end of 2024, growing to 116% of GDP, the highest level ever recorded, by the end of 2034. Now, as a consequence of this growing budget deficit and the total debt held, net interest payments will continue to be a growing outlay the government is forced to spend on, rising from $659 billion in 2023 to $870 billion next year in 2024. Now, this will rise again to $951 billion in 2025 and all the way to a whopping $1.6 trillion by 2034, a truly terrifying thought. And as you can see by the projected spending on national defence a couple of lines above this, net interest payments are set to flip national defence spending in 2024. Now, relative to GDP, these projections suggest that these interest payments will rise to 3.2% of GDP in 2025 and 3.9% in 2034. The scary thing is that 2025's interest payments would equal the previous high interest payment to GDP ratio of 3.2% that was set in 1991 during the post-World War II era, and based on these projections, this will easily be surpassed by the year 2034. Top economist Olivier Blanchard, who was a former chief economist at the IMF, has been very vocal on how worried he is about America's $34 trillion national debt, saying that there is absolutely no attempt to decrease the deficits in any way, shape or form. The US government's ability to keep spending at the pace that they have been doing in order to prop up and support the struggling economy is being majorly hampered by this ever-growing national debt and the interest payments that come with this. And now it looks like stubborn inflation and interest rates staying high for longer could make things even more painful for the government's budget deficit and debt load, as well as the economy in general. The latest US CPI data came in hot at a 3.1% year-on-year increase, an alarming amount higher than the 2.9% that was expected. And this continues the trend that we are heading down of inflation rates stagnating above 3% instead of breaking past the 3% barrier and heading towards the central bank's target of 2%. Now, the Fed and Jerome Powell specifically have been very vocal and very clear on their stance around rate cuts, where Powell did say that rate cuts won't begin until more progress has been made towards the central bank's 2% inflation target. And after this latest data, many economists now believe that this takes rate cuts off the table until at least June, which is a lot later than what was previously expected. What's even more concerning is that this inflation looks like it could actually start to climb higher again later on this year, judging by a number of economic indicators that lead inflation. Now, inflation is a lagging variable and does lag behind indicators like the Global Supply Chain Pressure Index, which hit a low point in May 2023 but has now bounced upwards and has continued to surge over the last 8 months or so. There's a lot of conflict in the world right now, which is leading to an increased pressure on global supply chains and higher shipping costs, which is ultimately causing prices to rise. When we map CPI over this Global Supply Chain Pressure Index, we can see that it correlates very closely with it, but just lags behind by approximately 6 to 12 months, pointing towards a surge in CPI very soon. Now, shipping costs themselves have surged on both a nominal and a year-over-year percentage change basis, plus we've also seen a year-on-year surge in the global food price index too, all pointing towards higher costs and higher product prices. Inflation stagnating and potentially rising soon, as well as interest rates staying higher for longer, is only going to make the government's debt problem even worse. The government is going to have to pay even more on interest for the new treasuries that are being issued, increasing the annual expenditure on interest payments, which is of course going to keep driving the existing budget deficit higher and higher. And the way that all of this is shaping up, this is also going to be very problematic for American consumers as well, many of which are already under a lot of financial stress at the moment. We know by looking at historic data that the unemployment rate correlates strongly with interest rates, but just lags behind by a few years. It's been about 2 years now since rates started getting hiked, meaning that the unemployment rate is likely to start to rise in 2024 and in 2025 if this historic trend between the two metrics remains the case. And we are already seeing widespread layoffs start to take place across the whole economy, including sectors like banking, financial and tech, while at the same time job openings are declining rapidly. If rates do indeed stay higher for longer, then this is only going to prolong the pain that we see in the job market and make the damage to consumer spending power even worse. Mortgage rates remain sky high, and after surging with interest rates last year, they are even higher than what we saw during the peak of the global financial crisis. Coupled with home prices still being extremely high as well, the national payment to income ratio is extremely high relative to historic levels, meaning that American citizens are on average losing more of their paycheck every month to home payments. And this is the same for those renting as well, with average rent costing about 23% more compared to at the start of 2020. Inflation has caused a cost of living crisis for many people, which has led to savings being depleted, as can be seen from the historically low personal savings rate, and this has led to a surge in credit card debt, which is now at all-time highs, above $1 trillion. This is hitting consumers hard due to how high interest rates are right now, with interest rates on credit cards on average surging from about 16% to now being 23%. And on a similar note, auto loans are the highest that they have been since 2008, now above 8%. We are consequently seeing credit card and auto loan delinquencies both rise rapidly. And with more US citizens struggling financially and getting into financial trouble, this is also going to have a toll on the government's budget. As the economy continues to weaken, corporations are going to be earning less in terms of revenue and also in profit, and social security outgoings will likely rise and have a toll on an already worsening budget deficit. And with major indicators like the leading economic indicators index pointing towards an imminent recession, this is also going to mean less tax income as well for the government. But perhaps the industry that is being hit the most by interest rates staying higher for longer is the banking sector, and there have been some extremely concerning developments there recently. I cover this whole topic in detail in my previous video, which you can check out by clicking on screen right now or in the description. Aside from that, please leave a like on the video and subscribe if you enjoyed it, that does help out the channel a lot, and thanks a lot for watching.